Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, we have a little bit of a mini special in the first half of today's show.
Yes, on the second day of trading for SK Hynix's ADR, we're going to talk about leveraged single stock ETFs.
Yes, and the ecosystem that has erupted around some of these highly levered names. Let's get to the biggest stories right now. In the nearly $22 trillion global ETF industry, more trouble in the tech sector. SK Hynix. It leads a chip sell-off today after its Wall Street debut last week.
And we discussed how the debut has led to a wave of leveraged single stock ETFs with Matt Tuttle of Tuttle Capital, who has launched one of their own.
And we're also going to speak with Cole Smead of Smead Capital Management on why mutual funds can match ETF tax efficiency.
What?
Yeah, we'll see about that. All that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. VU back on top. It's as usual. The last 2 weeks, VU wasn't on top. There was some rebalancing going on, but $4 billion into VU, so the Vanguard bid is alive and well. Now, SOX is interesting. SOX took in the most money ever in one day. It was like $5 billion flow, and I think it was people buying the dip because semis had a little bit of a dip, and people are trading that area. The volume in the semiconductor ETFs area is exploding. DRAM, which I guess is, we'd say related to that, $2.5 billion. It's now in the top 5 all the time. Again, amazing story. This is the ETF that holds 3 memory stocks and is now about $25 billion. Just crazy growth for a theme ETF that's only like 4 months old. Some small caps, some ARK, a little EFA value. That's interesting. And then SPIAM. We've highlighted this recently in BI. It's the ETF chosen by the Trump account. So a lot of babies are going to grow up knowing SPIAM. So watch this ETF to grow and grow in the coming years. Let's look at the outflows here. And you're going to see it's a little bit of a techie pullback here. Q's $8 billion out. SPY $4 billion. IVV, HYG, which is junk bonds. So definitely some risk-on pullback from the trading crowd ETFs. FXL is also a tech ETF, and there's communications. So definitely, I think, a little bit of nervousness there on that tech trade. Now, speaking of the tech trade, semis, and all this, as you mentioned, Katie, I want to talk about leverage ETFs. This has been kind of a hot-button issue lately. They are launching like crazy. So they seem like they're in our face, right? And they are. They make up 34% of the launches. And there's 1,000 ETFs to launch. So there's about 350 leverage ETFs launching every year. That's like one a day. They make up 13% of all ETF trading. That's a lot, right? People trade them, but they still only make up 1.2% of assets. And if you take the leverage, they're $200 billion, and you add the notional, it gets about $450 billion of notional exposure. That's less than 1% of the entire equity market. So they are very highly used. Launches like crazy, but asset-wise, Katie, not that big yet.
Eric, thank you. And on that topic, Bloomberg opinion columnist Aaron Brown weighs in on leveraged ETFs, writing, the moment a hot AI name trades in New York, the issuers race to lever it. The system is stable for now in the way a row of dominoes is stable. Every piece individually hedged, the eventual loss already sold to the retail buyer who mistakes a paper gain for profit and to the yield-hungry fund that wrote the crash insurance. The only open variable is how tall the pile grows before the AI trend finally breaks. Now, before writing for Bloomberg, Aaron Brown was chief risk manager over at AQR Capital Management. I'm thrilled to say he joins us now. Aaron, great to have you with us. So dominoes actually are pretty stable until something knocks them over. So just lay out this daisy chain for us. I mean, what could be the actual catalyst here, and what might that look like?
Okay. Well, before getting to the catalyst, the first thing is, why does this have to fall? If you take, for example, a 2 times levered ETF on NVIDIA has to go up 40% a year just for the ETF to break even, not to make money, not to match the 40% of the stock, but just to not lose money. And yeah, it can go up 40% in a year, it can go up 3% in a month, but it can't go up 40% forever. It would be bigger than the entire, universe, the entire world economy. So eventually these things have to go to zero, and when they go to zero, the 200 billion investors have in them goes to Wall Street. So that's baked in. That's going to happen. The question is, will it happen so fast that the jump risk actually bankrupts some firms and causes some systemic risk? Sort of the people writing the cliquet options that that hedge these things. The banks issuing them, the banks doing the swaps, and the issuers, those people will probably be okay and make a lot of money. But investors will lose, the people writing the insurance will lose, and hopefully it will happen slowly enough that it doesn't spill over to a major contagion.
So leveraged single stock ETFs are definitely risky, but the defendants would say that people who use them don't buy and hold them. They buy and trade them pretty quickly within a day. So they're not looking for NVIDIA to continue going up infinitely. They're just looking for that quick turnaround.
Sure, and that's the greater fool theory, that there's always going to be somebody to buy it for you, but sooner or later somebody's got to hold it when it goes to zero. And yes, these things can be, very profitable for people doing day trading, or even, you can even hold it for a month or two, and with some, if you're really bullish on the underlying stock. But the point is, the money is there, and the money can't get out.
Let me push back on that a little bit. So these leverage ETFs have been around for 20 years at this point. TQQQ is the biggest one. It's seen a bunch of cycles at this point. In 2022, there was about 72 leverage ETFs that kind of like lowered their leverage or just got wiped out. And it does seem like a cyclical thing. You have a bull market, some more launch, then the hard rain comes and they get wiped out. The people using them, I think, understand this. And for the most part, if you look at these funds, they do see outflows as they grow, meaning people are taking profits all the time. And I think that's why they're popular. I think the people using them feel like they get a good deal, even with those cycles where they do go down a lot. You think that people are going to have a nasty surprise this time versus the other times?
Well, okay, maybe I should make something very clear. There's no problem with a leveraged ETF by itself. The problem is in levered ETF on a stock with 50% annual volatility, or these gigantic volatilities. So doing a leveraged ETF on the S&P 500, on a reasonably stable stock, that can make sense. It can even make sense in the long term. What it has to go to zero at some point is a leveraged ETF, a 2x ETF on a high-flying AI name, or a 5-time ETF on anything.
And Aaron, reading your column, you talk about how, when you think about the U.S. market, these single stock leverage funds, they're capped at 2x leverage. That's a different situation than maybe that you see in Europe. But you also make the point that when there's hundreds of them that we're talking about, they're all pointed at the same trade here. And I wonder what the collective risk is there, because, you could say, okay, 2x leverage, that doesn't seem like, that wild or that out there.
Well, it isn't for a safe stock or for a broad-based index like the S&P 500, but it is. And by the way, there's not a cap. It's not like there's a law you can't have more than 2x in the U.S. It's the U.S. regulators look at the volatility of the underlying, which is the right way to do it. The problem is these AI stocks have just such tremendous volatility, and they're all correlated. They all go down together. And when they do, it's very much like the monoline insurers back in 2008, for people who remember that far back. They wrote insurance on mortgages. They made them on the assumption that, a mortgage in some areas can go down, housing prices can go down locally, but the national housing prices won't all go down together. And then, of course, the national housing prices did all go down together. The monoline insurers got wiped out. They couldn't pay, they couldn't pay off on the bets they had made to protect other financial institutions, and it was a broad-based contagion. Now, this is not going to be that bad. The $200 billion in levered ETFs, and it's not the whole $200 billion that's the problem. It's the high-flying, highly volatile sections of that. So I don't know what that is, say $50 billion or something. And that's not going to wipe out the financial system.
And perhaps the best example of that, Eric, is the ETFs, the leverage ETFs on a name like SK Hynix, which until recently wasn't available for trading in the U.S. Until the ADR launched last week, and of course makes up almost the majority of its trading overall. Yeah, that's a small fish in a small pond where the fish got big. It's an unusual situation. The ADR should relieve some of that liquidity. But yeah, that's an example of where the tail was wagging the dog a bit. Aaron, I want to ask you just a little bit about, if we take some of these 2x AI, I think that's where your issue is. What's the limit? Like the SEC says no 3x, no 4x. They did set a line there. Do you think
the stock shouldn't be too small or too volatile to 2x. My metaphor for this is like fast food and whiskey. It's something that is legal, but not necessarily healthy. And so I don't necessarily judge the intent of the user. We have a traffic light system. We give them red lights to say, hey, there's a couple warnings here. What do you think should be done if you were like running the SEC?
Well, I'm kind of a libertarian, so if people want to kill themselves on levered ETFs, well, it's, there's lots of other stupid things they can do with the money. But the key is they have the right idea, which is you look at the volatility times the leverage, and that's what you want to limit. The problem is the volatility can spike, and when the trouble hits, some of these stocks are going to go to 100%, 200% volatility on the underlying stock. And if you got 2 times leverage on that, it's just suicidal.
It reminds me of a quote that I love from Rob Arnott, that stupidity is a human right, not investment advice, though. Aaron Brown, really great to get some time with you. Appreciate you joining the program. That is Aaron Brown. He is the author of the recently released book, Wrong Number, and a columnist with Bloomberg Opinion. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And here's one that we were talking about a lot last week. That is SPY-M being selected as the default fund for Trump accounts. Bloomberg Intelligence out with some predictions here, estimated to bring in 28 million new investors and $12 billion in new flows in the first year. So we'll see what exactly materializes, because it's already been a breakout year for SPY-M. Meanwhile, let's talk about Bitcoin. Also a breakout year in a bad way. When you take a look at the outflows here, those outflows persisting rather for an 8th consecutive week. Really interesting, even though you have seen some signs of life reemerge in the cryptocurrency itself, hasn't really turned the tide when it comes to the flow of money. But let's end with part of a conversation I had last week with George Maris of Principal Asset Management. We were talking about the effect that leveraged ETFs, specifically single stock leveraged ETFs, have on the entire market.
With that 24/7 news cycle and all of the financial innovation that's democratized things and created the use of leverage tools, we're going to create heightened structural volatility in markets. It's just a persistent feature for it. We can look to Korea for a phenomenal example of what that leverage can do to markets.
Katie, speaking of leveraged ETFs, a whole new batch of single stock leverage funds are being cooked up around Korean memory chip maker SK Hynix. And a number of those funds expected to start trading as early as this week after SK Hynix listed on the NASDAQ Friday. And one of those new funds is the Rex Shares T-Rex 2X Long SKHY Daily Target ETF. That fund is courtesy of Tuttle Capital Management, whose CEO and CIO, Matthew Tuttle, joins us now. So this is based on the ADR that's trading in the U.S. There is already a leveraged single stock ETF on SK Hynix that has grown tremendously in Hong Kong. It's the CSOP SKH Daily 2X product. What have you learned? What did you learn from watching that ETF in coming up with your version?
I learned there's a lot of demand for it, basically. And, and we're in the business of giving people what they want. I heard your previous guest talk, well, leveraged ETFs are bad on the volatile names. Those are the names people want to trade. SK Hynix is a name that obviously Korean, Asian investors love. It's a name U.S. investors have been trying to get into. Part of why you saw the flows into DRAM, the flows into EWY. Now there is a pure play way for U.S. investors to get access to this name. So, yeah, we think this is going to be great.
Let's talk about the Derby. Every now and when you line a bunch of ETFs that launch on the same day, it is like a horse race. I've already seen press releases. Corgi's like we're the cheapest, leverage shares like we're the best. Everybody's jockeying for position. Talk about this. We just saw with SpaceX with the 2X. That was a Derby. Leveraged shares seemed to get the edge, which was interesting to me. What is going to matter? Do you call all your friends and family and say, look, will you please trade this thing on day one? I need some volume. So Eric Balchunas will say we're winning in volume, and we can be like, got that sort of golden halo to begin, and then people will start coming. Talk about the first day or two and what you do to get ahead of the pack.
Yeah, so we do as much as we can. So, for example, we're opening at 4 a.m. Never done that before. I'm up anyway, so I don't care. I'm hoping some of our market makers are up as well. And so that's one thing we're doing. Reach out to all the market makers, all the social media, talk to as many people as you can. I think a lot of times it's more luck than anything else. We want to have the ticker symbol in the name, make it easy for people to find. And, then you see what happens, and volume creates more volume. So, yeah, I will expect you to be tweeting right off the bat at 4 a.m. that ours is the one with the most volume.
And Matt, obviously, I mean, you're an issuer. You want to get a product out there that people want to trade, and clearly people want to trade SK Hynix. But what do you make about some of the concerns that do exist out there, especially when you take the South Korean markets as an example? We've seen these leveraged products, the fear there that this is fueling a lot of volatility when it comes to the underlying name itself. Does that factor into your thought process when you're cooking these up, or is that just a byproduct?
Well, I mean, it doesn't, because these are just tools. And if levered ETFs didn't exist, people would find other ways to get leverage. They'd use options, and in options, I can get way more than 2x. They would use futures, single stock futures, whatever. You're always going to find a way to get the leverage you want. To me, having something that's capped at 2x is safer for the marketplace than maybe if people were just flooding into the options market. You were seeing gamma squeezes, all sorts of those things happen.
So speaking of 2x, that's kind of where the SEC will go in terms of limits. In Europe, we've seen 3x, and there was, I believe, a filing for 5x, which didn't go anywhere. If the SEC were to open up and say, okay, 3x, 5x is allowed, is that something that you would jump into?
It's something we'd have no choice to jump into. It would be a competitive situation. What we've seen is here where you do have a 3x, the 3x is more popular than the 2x. So we would definitely jump in. We think that's something that there would be a big demand for. And we'll see. I mean, we've got filings in with the SEC. Nothing is happening with them. Our competitors have filings in. Nothing is happening with those. I don't expect anything to happen, but, you could have argued we'd never see a spot Bitcoin ETF. So you never know.
Let me pivot here and talk about the government-gripped ETF that is so controversial that
the filing.
Well, no, it's effective, but nobody will list it. You're like 86 from the exchanges because of the name. It's like a little too on the nose. We looked at the stocks that the White House invests in or that Trump tweets about, and if you made a basket of them, you crush.
Oh, yeah.
So why not change the name to something that could get you over the goal line with these exchanges? Because it seems like a good trade.
It's something I do think about every once in a while. I still hold out hope for Texas as well. You never know. The problem, too, we've got to figure out is marketing, but then also saying what it really is, and that's what it really is. We've got a names rule where...
What about White House asset management? I mean, they let the Nance ETF come out, and that's pretty close, but... Yeah, I don't know. Just a thought. Just curious about that.
I appreciate that. I will take that under advisement.
All right, the ticker symbol could be WHAM, and we could be seeing that.
I still like GRFT.
The exchanges don't. That's the problem.
I know.
It always comes back to the ticker, doesn't it?
It does.
All right, Matthew Tuttle, CEO and CIO of Tuttle Capital Management. Thank you so much for joining us today.
Thank you.
One of several single stock leveraged ETFs on SK Hynix coming up. Still ahead on ETF IQ, we look at a cybersecurity fund through the Bloomberg traffic light lens next. This is ETF IQ on Bloomberg. It's time now to take a look at the Bloomberg Intelligence traffic light system, which ranks ETFs by risk levels. Green light means low risk, yellow light means moderate risk, and red light means high risk. Eric, what do you have for us today?
Okay, so we just went over a lot of crazy hot sauce and like red light stuff. So let's do a very vanilla one today to just shift gears here. The Global X Cybersecurity ETF with the ticker BUG. very cute, right? But what is really sensational about this, up 70% in a couple months, it is on fire. And it's completely no alerts, nothing to see here.
No buyer beware.
No, it's market cap weighted, long only equity. There's nothing to say. So I know we usually find ETFs that have alerts, but sometimes it's interesting to find one that you might think has an alert but doesn't. So I brought it up because cybersecurity is a nice downstream AI play that people aren't talking about.
Yeah, well, let's talk about it here because, I mean, what a year Bug is having. I love the ticker Bug so much. But talk to us about how exactly that works. So AI is the idea that basically you're going to see more and more of these cybersecurity incidents?
Yeah, because everybody's going to have all these agents and all this stuff going around. You're going to need protection. You don't want to get anything, especially quantum, you get some of that, and people are going to be able to hack into everything. It's going to get really crazy out there, I think, and I think people are like kind of looking forward and being like, people need to protect themselves from all the AI and computers just going wild.
Absolutely.
So there's no leverage, there's no leverage, and it's a passive fund. Does that mean all passive funds are green lights or not necessarily?
The most part, we just assume you go in thinking you're buying something like VU. And this is close to it. It's the VU of cybersecurity. Now, if it equal weighted, we would point that out because that means more vol. This thing is a little vol, but it is, again, it's a classic market cap weighted index, very VU-ish, clean slate. Nothing to worry about here.
All right, well, flashing green light for Bug. Eric, thank you. And you can take a look at the traffic light system on your terminal at BI ETF Go. Now, coming up, we're going to drill down into a momentum fund with Travis Spence of JPMorgan Asset Management. That conversation up next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu here with Katie Greifeld.
And it's time for today's drill down where we focus in on one ETF. Eric, what do you got?
Katie, thank you. Today we're looking at JMOM. This is the JPMorgan US Momentum Factor ETF. Okay, what does that mean? Okay, it basically chases performance. Now, people say you shouldn't do that, but believe it or not, that actually works. Evidence in academia has found that actually trend following and actually chasing performance can actually be beneficial. They use a proprietary method. So this is not active. JPMorgan is mostly active, but this is not. You can see here, actively managed, no. And the index is proprietary. It's a JPMorgan IP still. Look at the fee, though, 12 bips for an active strategy, essentially. It's just rules-based, but it essentially is trying to outperform. And look at the size, 2.5 billion. Katie, they grow up so fast. Did you know that was 2.5 billion? Sometimes I look around, I'm like, oh my God, I can't believe that's so big. Let's look at the holdings, rather. And I want to show you the sectors that this thing is in. It makes sense. It's in all the hot sectors, semiconductor, software, tech, right? Let's say we had a big shift in the market and all of a sudden industrials were big or natural resources. This would all change. This thing is like a heat-seeking missile. It's just going to go follow the stuff that's working, and that's momentum. And it's probably the second most popular factor after value. Let's look at the performance of this versus the big one on the market, which is MTUM. That's the iShares momentum, and also SPY. And you can see they're about 5 years old is this ETF, and it's done better. It's outperformed MTUM. And both of them have outperformed SPY. So that's why people like these factors, Katie. They can work in a systematic fashion and beat the market.
Absolutely, Eric. Thank you. And joining us to talk about this ETF, I'm pleased to say, is Travis Spence. He is Global Head of ETFs over at JPMorgan Asset Management. Travis, great to see you in person.
Great to be back, Katie. Thank you, Scarlett.
So
Eric?
it's a great year for JMOM. And I wonder, as, in your perch as Global Head of ETFs, how do you sort of capitalize when an ETF is having a breakout year such as this one? Because I take a look at JMOM right now, roughly double the total return that of the S&P 500. I mean, how do you sort of factor that into how you're positioning different products in the stable that you have?
Yeah, well, first of all, and this is going to be a little bit of a shout to you as well, given your position. I know you're going to be going out soon, but I love the ticker name and the reference because it's my mom's 85th birthday, so I'm going to give a shout there.
Oh,
Happy
wow.
birthday!
I didn't know that. It was all meant to be.
It was all meant to be. But look, this is we've developed our platform over time, and this was one of our early ETFs that we launched. This was around the momentum factor, and we have quality and growth. And there was a time when we had a lot of investors looking at factor ETFs, and so this was one in that stable. And this is a kind of market, as you've covered well on this program, where momentum has been a driving factor in the year so far. However, I think what we're really seeing is, most of our platform, as you know, is active, and we're really seeing that pick up this year. And I think there's some interesting things going on. You think about the equity market now. The S&P returns, only 3% came from, or the Mag 7 was delivering about 3% returns. That's 12% under where the S&P is right now, and the other 493 are delivering an outsized performance, about 13%. So there is some structural changes happening that I think we all need to be aware of. We did come into the market thinking that there was going to be a greater diversification of companies and earnings, which we're seeing, and also a greater diversification by geography and by sector. So that's starting to play out, and I think that's what investors need to be thinking about as they look forward.
Well, momentum, as Eric pointed out, is really chasing performance. And what we've seen, of course, is this drive away from just Mag 7 into the memory chip space. I look at how the memory chip makers have performed overall, and they peaked on June 22nd. And since then, it's been a rocky road. And they've come down. They're still very elevated compared to where they were 3 months ago or a year ago. But I'm curious what the JPMorgan perspective is on the sell-off that we've seen in South Korean chip companies like SK Hynix, like Samsung Electronics, dragging down the Kospi and kind of setting the tone for the U.S. markets rather than the other way around.
Yeah, look, I mean, we don't. I mean, there's in our position and what we've put out on our platform and our ETF range, it's that focus on core management, core active management. And again, so we don't want investors to be chasing performance. If you look at the active ETF flows so far this year, we're on a record pace, like way beyond where we were last year. And last year was a record. So 400 billion year to date. Last year, the total was 475. So we're already running about 65% above. And what I find interesting is where we see those flows going into. 85% of those flows are going into core equities, core fixed income, derivative-based and derivative outcome, which are now a part of core portfolio construction. But that's where we really see the momentum going into. So I think it's interesting. Yes, you're going to see some of these anomalies, pick up where there's a very specific theme and you're seeing a lot of momentum behind it. However, I think go back to portfolio construction. Now is a really interesting time to rethinking portfolio construction. And so in addition to like that core element and what we're seeing driving flows, the other part of that that's really starting to pick up is model portfolio allocation, where I would say the marginal dollar is really going into the active ETF side. Again, you're going to play in some of these spaces. Investors will play in some of these spaces, but the driver of flows is really into that core space. The other part that I find really interesting now, and especially as we've seen the active ETF industry cross over the 2 trillion mark in the US, 2.5 globally, is that you're getting the larger investors coming in. The biggest asset allocators, the biggest institutional asset owners are starting to look at not just using ETFs for tactical, but for core parts of their portfolio, and they're leaning in with size.
So I want to go to JEPI because JEPI has 1,500 13F filers. That's a lot. So JEPI is the biggest active ETF in the world, but now it's got a target on its back. I go around all over, and these other issuers are like, oh, we got the JEPI killer here, where this is better. The main thing is JEPI has a lot of yield, but that drags it a little bit in a bull market. So they're like, we have more market appreciation, a little less yield. We think it's a better JEPI. What do you say in response to these ones that are coming for you?
Yeah, well, so I'm going to make my last World Cup reference because I can do it before the weekend ends. Investors, this has been an offensive market, right? And everyone's wanting to go into that momentum trade. However, investors also need defense. And what we found about a week ago is that if you don't have a good defense, you're going to end up 3-0 down and pretty quickly. So you want to have that protection in your portfolio. Fixed income has been one of the ways to get that ballast in the portfolio. The other has been the derivative outcome space. So then I think it's a matter of where you want to sit on the spectrum within the derivative income range.
Right.
What we've observed is over the last few years, since we launched JEPI, there's been an increase of investor awareness, but also, investors are looking for different things. So that was part of the reason why in May of this year, and you guys covered this well, we launched a broader range. We broadened out from JEPI and JEPQ. We launched ROC and ROCQ. So now investors have a full range of things that they can consider, where they want to sit on that spectrum, how much yield they want. There's always a bit of a trade-off. So that's a decision that I think investors have now.
Right. And Travis, we only have about a minute left, but I do think it's interesting that you think about how JPMorgan is approaching active when it comes to equities. As you said, it's a lot of defined outcome strategies. And then you also have this big presence when it comes to active fixed income as well. Are you taking a more alpha-seeking approach when it comes to active? Does active management mean something different in fixed income for you than it does in equities?
I think the big thing is that active has always been there in fixed income. Investors have preferred it. 80% of the mutual funds are actively managed, so it's always been there. I think investors are really missing a trick on the passive side at a time when you really want to be rebalancing your portfolio into fixed income. So the U.S. Ag doesn't include about 50% of all the available bonds in the universe in the U.S. So you can be very successful by being an active. Another ticker that I'll raise is JCPB, which is our Core Plus Bond ETF. That's our second largest bond ETF today. It's about 14 billion almost, and has taken in almost 7 billion. So what that does is it gets the best ideas from across our fixed income platform. It invests in areas that the U.S. Ag doesn't, securitized munis, et cetera, high yield, and it's been delivering about 1% alpha over the benchmark. 1.35 annualized. So really, really strong, consistent returns. And that's what's driving, I think, a lot of the flows now into the active fixed income ETF space.
Well, Travis, it's great to see you. Appreciate you stopping by while you're in New York. That is Travis Spence of JPMorgan Asset Management. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. But coming up next on ETF IQ, the television show, we're talking about the renaissance of the American mutual fund. That's actually allowed.
On ETF IQ?
Yeah, apparently. Cole Smead of Smead Capital, he joins us next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu. Let's get you to the ETF Lifecycle, where we walk you through the three main stages of ETFs, from initial filings to final farewells. Step one is the filing. Tuttle, Financial, and Subversive ETFs teaming up on a pair of actively managed event contract funds, better known as prediction markets. The Subversive Prediction ETF and Subversive All-Season Sports ETF will trade and invest in event contracts. The first fund will focus on economic outcomes, regulatory or trade policy contracts, climate and weather contracts, and global macro events. The second fund, meantime, zeroes in on all sports contracts, including professional sports leagues and college athletics. Bloomberg Intelligence does not expect these to gain SEC approval anytime soon. Step two is the launch. BlackRock's first NASDAQ 100 ETF, ticker IQQ, began trading. It has a fee waiver that brings its fee to just 10 basis points. State Street and BlackRock now both have competing products tracking the NASDAQ 100 index, which was previously monopolized by Invesco with QQQ and QQQM. And for some, the final stage is farewell. The Vista Shares BitBonds 5-year enhanced weekly distribution ETF is shut down. Ticker BTYB was an actively managed fund that targeted weekly income by holding a roughly 80% allocation in intermediate U.S. Treasuries and a 20% holding in Bitcoin-related assets with a synthetic covered call strategy. And that is this week's Life Cycle. Katie?
Well, let's do something sacrilegious and take a step outside the world of ETFs, because our next guest argues that mutual funds can offer just as much tax benefit as ETFs, writing, quote, most financial advisors believe ETFs hold a structural tax advantage over mutual funds. They don't. The mutual fund industry simply isn't using the rules that it has at its disposal. Joining us now is the author. His name is Cole Smead. He is the CEO of Smead Capital. So, Cole, just briefly lay out your argument for us here, because it seems like you're saying that mutual fund managers are passing up a big opportunity here.
Yeah, they are. If I was getting, I think it's of biblical proportion. So it reminds me of like the story of Jacob and Esau. Esau was a fool. He gave his birthright away to his brother, and Jacob was the man. Okay, and that's kind of where we're at on the ETF land right now, is that, in effect, the birthright, which is referred to as 852b6, came about in 1969. It was explicitly created for mutual funds. 24 years later, the SPY ETF was created knowing they would be doing in-kind redemptions, a la non-taxable distributions out of that ETF. And so we wake up in a world today where everyone just outright assumes the ETF has this structural advantage, and it's really because the mutual fund industry has not adapted to that. Now, if you go back, you can go find Wall Street Journal articles about Sequoia Fund doing these in the 1990s, for example. As trading costs have come down, it's made it a lot more easy for both products to do. But then the second part is, there's groups like Reflow out there that have done this for, I'll call it 27 years, I think is when they got their original waiver from the SEC to do this kind of stuff. Our main point is this. If you go look at who's doing this in mutual fund land among, say, the dealers, go look at the authorized participants on all the ETFs that you have on your show. And generally speaking, that's a good lead list to figure out who's doing these kind of transactions with funds. I think the other part to this too, Katie, is people just need to know that hey, you're not going to drown. You have to amend some policies. You need to do some different work. You need to start studying things like tax contagion in your liquidity management. But, we're not talking about rocket science here.
So why is it that mutual fund issuers, mutual fund companies haven't gone down this road to use in-kind redemption?
Yeah, at the bigger asset managers, great question, Scarlett. So at bigger asset managers, they're effectively restructuring their business in the open market. Okay, look at the big asset managers. Who's raising the most in ETFs? Okay, so they're effectively taking and allowing the outflows of their mutual fund assets to wake up in ETFs. That works fine for the big issuers. They're ultimately at a high level beta plays across their asset base in many ways. As you go down to, say, the sub-$100 billion realm, or even maybe sub-$200 billion realm, that's just a different conversation. What you've seen there is you've seen some ETF conversions. I can show you good examples of that not working, because the whole idea is it'll raise more money, and they wake up later with, they're now tax efficiently operating, but it didn't necessarily bring in flows. I think our main thing we're trying to attack in this is educating the industry. Our job is here to educate people, and they get to make their own decisions. We don't see any databases tracking this. If you want to know where to look, go to any ETF or mutual fund's annual report, and you can look at a line called in-kind redemptions. And you'll see it plain as day in the semi-annual or annual report. Those documents that no one reads, that has all the really good information. Okay? And so we look at this as there's a big marketing problem on the mutual fund side. I would guess that from 2 years ago, the number of funds that are using this have doubled. And I think it's really the question for the fund companies, do we not want to amend our policies and just go to the ETF, or do we add an active ETF share class at a later date? I think those each have problems. Do you want your investors paying Wall Street a vig on the way in and way out on spreads? I don't think they should. That's just how we think about it. And then in the active ETF share class land, you have big distribution problems. Reg BI is going to run amok on what comes out there. I think a better way of thinking about this is actually looking at an ETF issuer. Go look at FM Investments. They're filing to create a mutual fund share class. Why? Because they want to deal with 401ks. So I think people aren't understanding the total answer to this problem, which is that, you guys were talking before, how do you work with both your non-taxable and your taxable investors?
So, Cole, just in about 45 seconds here, the problem with the mutual funds is 40 years of capital gains distributions for doing nothing but staying in the fund. Will this solve that, and is it too late? Is this just a dollar short and a day late in terms of the mutual fund and its reputation because of all of those years of getting capital gains distributions for literally being a good soldier and staying in the fund?
It's a great question. Here's our problem. We were born with something called the fiduciary gene, and if it's to our investors' benefit today, you do it as long as it's there to benefit them. To your point, just because people did stupid things in the past doesn't mean you should continue to do stupid things. And I think this is foolish and bad on the mutual fund industry, because a fiduciary would say what's best for our customers. We're going to do that regardless of how much more extra work that creates for us. On the flip side, the average ETF is hardly out of the cradle, guys. The median or average is less than 3 years old, like we've talked about, Eric. So if 852b6 goes away, because, say, maybe Senator Ron Wyden out of Oregon would like to get rid of that sometime in the future,
right,
the ETF business will go away.
All right, Cole Smead, with some strong fighting words there of Smead Capital. Thank you so much for bringing us all of that. Now, coming up on ETF IQ, we're going to stick with ETFs away from mutual funds because it's time for an IQ test. Joel Weber putting our knowledge to the test. Here's a sneak peek at one of the questions. There's more than $50 billion in leveraged long single stock ETFs. How much is in leveraged short single stock ETFs?
Ooh.
Anywhere from 0.7 billion to $5.1 billion.
Yikes.
This is Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas. And it's time for an IQ test where Bloomberg's Joel Weber is going to see whether Scarlett, Eric, and I really know our stuff when it comes to ETFs. You know Joel is the co-host of the Trillions podcast with Eric, and also as the head of games at Bloomberg. What a crazy title. Joel, welcome back.
Here we are. Ready for more?
Yes.
Okay. Did you been studying a little bit?
A little bit.
Okay.
You know.
We'll see about that. First question. State Street's Spider Portfolio S&P 500 ETF, SPY-M, is the default investment for Trump accounts. Which of the following is not among the other investment options? IVV, BND, ITOT, or VTI?
I think it's A, IVV.
Okay. Katie?
I think it's B, no bonds allowed.
It is
Eric?
B. It is B. Trump doesn't want bonds. They're too slow.
Sorry, Scarlett. Yeah, B and D was
okay.
the outlier. I went for a really vanilla sounding thing to.
You know
put
what?
In,
In retrospect, it's obvious.
Yeah,
There's one that doesn't belong
There were some
here.
equities.
One of these is not
going
like
for the
the
long
other.
term.
Yes, exactly.
Okay, question 2. The DRAM ETF has been a smash hit in the U.S., giving investors exposure to the memory chip industry. Which issuer recently launched a European version with the same ticker? A, Defiance, B, Roundhill, C, Van Eck, D, Global X. If you could get close up of Eric's face, I don't think he knows this.
Oh, man.
Scarlett.
Roundhill's a choice, which is intriguing.
Yeah.
That is intriguing.
I feel like it has to be Roundhill because it was Roundhill's idea.
Okay.
I'm going to say Defiance. Seems like a defiant act, if you will.
I'm going to go with C, Van Eck. I just don't think you'd ask if it was Roundhill.
Okay. A is Defiant.
Good one.
Nice, Katie.
Incredible.
Wow.
Joel,
2-0.
We have 30
You
seconds.
were studying. Okay,
I was
final
studying.
final one. There's more than 50 billion in leveraged long ETFs. How much is in short single stock ETFs? 0.7 billion, 1.3 billion, 2.6 billion, or 5.
I'm going to go with B, 1.3 billion.
I'll go with B as well. I know it's small. I just don't know how small.
I'll go with C.
And the answer is B.
Wow.
I think
Look at that. Katie.
Katie,
you did
three
your
for
homework.
three.
Perfect
Yeah.
score.
And
Wow.
Eric, 1 and 2, I think it was.
I know. I had a bad week.
So,
Well,
of course,
That
if you
was a
like,
good week for me.
Okay, if you like this, play more games at Bloomberg.com/pointed. We've got a news quiz where you can play with some levers
All right.
and stuff. And of course, quiz go.